One question, which is at every investor's mind, is whether the stock market will rally at year-end or not, or will we have a Santa rally this year? Here are the top 5 reasons why you should witness a stock market rally at year-end and in 2024 as well. Before we dive in details, please subscribe to the channel and stay always one step ahead to know all global important events happening around you. Give a thumbs up and share the video with your family and friends. Let's move on with the video. No one, the end of the Fed's tightening cycle. We believe the Fed's historic tightening cycle is nearing an end, if not already over, Adams said, even in the face of a strong 4.9% GDP growth print in the third quarter. He highlighted that the core PCE indices show an ongoing trend of inflation decelerating, which is the Fed's top priority. This should give the Fed comfort to pause at their policy meeting this week, given we expect growth to soften and the jobs market to cool further as we head into the final months of the year. The Fed's job is likely done, Adams said. If we're correct, this should bode well for stocks as the S&P 500 typically gains 14% the 12 months after the Fed's final rate hike. No. 2. Stop in interest rates hike. The macro drivers of a softening economy and continued disinflation should limit the upside in interest rates going forward and should eventually lead to interest rates falling, not rising. If this happens, it should support an improvement in the multiple driving equity prices higher, Adams said. No. 3. Solid megacap tech earnings. The S&P 500's earnings recession is set to end in the third quarter, largely thanks to the solid results from megacap tech companies like Microsoft, Alphabet, and Amazon. But investors don't seem to be taking notice yet. There is an apparent disconnect between the actual results and the market performance of several of the mega-cap tech names that reported last week. For example, despite posting blended EPS growth of 44% year-over-year and crushing estimates by 13% in aggregate, a composite of Magman declined 4% during the week and is now down 10% from recent highs, Adams said. Magman refers to the earnings results from Microsoft, Amazon, Alphabet, Meta, and consensus estimates from Apple and Nvidia. These price moves are inconsistent with fundamentals, and the positive results from these mega-cap names combined with solid results from the financials leave us confident in our 2024 S&P 500 earnings forecast of $220 to $225, Adams said. No. 4. Year-end seasonal stock recently have been following seasonal patterns seen in the last 50 years, namely declining in August, September, and into October, Adam pointed out. Fortunately for investors, the seasonal trend is set to turn to a tailwind as we enter 2 of the strongest months of the year, with the S&P 500 up an average of 1.5% and 1.2% in November and December respectively, he said. No. 5. Bearish sentiment flashes contrarian signal. Investor optimism towards the stock market has largely evaporated over the past couple of months, Adam highlighted, with bearish sentiment in the AAII investor survey jumping to a 5-month high. That represents a contrarian buy signal. Cautious sentiment leaves us more optimistic that the market can move higher over the next 12 months. Looking ahead, this trend is unlikely to reverse. As technology continues to evolve at a rapid pace, so too will the opportunities for investment in the tech sector. We're standing at the precipice of a digital future where technology companies will continue to drive economic growth. In a world increasingly reliant on technology, tech stocks are set to drive the stock market forward. So, whether you're a seasoned investor or just starting out, keep an eye on the tech industry. It's a sector that promises not only innovation, but also significant returns on investment. Think about the economy's recovery from recent crises. The bounce back from the COVID-19 pandemic is not just a hope, but a reality that's unfolding in front of our eyes. As we delve into the third decade of the 21st century, we see a global economy that has learned to adapt, survive, and thrive amidst unprecedented challenges. In the aftermath of the pandemic, it's clear that economies across the globe have shown remarkable resilience. Governments and central banks have injected trillions of dollars into their economies to keep them afloat during the worst of the pandemic. Now, as we see the light at the end of the tunnel, these massive stimulus packages are starting to pay dividends. The impact of this recovery is not limited to any one sector. From tech to healthcare, from manufacturing to retail, every sector is reaping the benefits of a strengthening economy. Companies that had to scale back during the pandemic are now ramping up production, hiring, and investment, all of which bode well for the stock market. Unemployment rates are falling, consumer spending is rising, and business confidence is growing. As economies recover, so does investor confidence. You see, a strong economy often translates into strong corporate earnings, which in turn drives stock prices higher. Therefore, the current economic recovery is likely to have a positive impact on the stock market. As we move forward, the continued rollout of vaccines, along with technological advancements and innovative business models, will further fuel this economic recovery. Countries across the globe are opening up, travel is resuming, and consumers are eager to make up for lost time. In this context, the stock market is not just a reflection of the economy, it's a barometer of human resilience, innovation, and adaptability. It's a testament to our collective ability to bounce back from adversity and forge ahead. So, as we navigate through the rest of 2023 and into 2024, it's important to remember that every challenge presents new opportunities. As the world economy recovers, the stock market stands to benefit. Ponder on the impact of low interest rates. This economic tool, seemingly benign, wields a remarkable influence on the stock market. When central banks lower interest rates, they set in motion a chain of events that can stimulate economic growth and, in turn, boost the stock market. But how does this happen? Well, it's all about the cost of borrowing. When interest rates are low, it's cheaper to borrow money. This encourages businesses to take out loans to expand their operations, hire more employees, invest in new technologies, and even buy back their own shares. All these activities can lead to increased corporate profits, which can drive up stock prices. But it's not only businesses that benefit. Consumers also find it more attractive to borrow when interest rates are low. They might take out a mortgage to buy a house or a loan to buy a car. These purchases stimulate economic activity and can lead to higher stock prices as companies in the housing and auto industries, among others, see increased demand for their products. Investors, too, get a boost. As it becomes less attractive to leave money in a savings account earning low interest, they may turn to the stock market in search of higher returns. This influx of capital can drive up stock prices, creating a positive cycle where rising share prices attract more investors, which in turn pushes prices even higher. But let's not forget the cautionary note. Like all economic tools, low interest rates are not without their risks. They can lead to inflation if the economy overheats and can encourage excessive borrowing, potentially leading to financial bubbles. However, with the right checks and balances in place, low interest rates can be a powerful tool to stimulate economic growth and boost the stock market. As we look towards the end of 2023 and into 2024, it's this economic backdrop of low interest rates that creates an environment ripe for a stock market rally. With interest rates remaining low, the stock market is poised for a rally. So, what does this all mean for the future of the stock market? We've ventured through the landscape of the future of stocks, delved into the power of technology, assessed the promise of economic recovery, and examined the impact of low interest rates. Now, let's stitch these threads together into a comprehensive picture. The future of stocks, we've seen, is not a mere game of chance. It's a tapestry woven with the threads of multiple factors. Technology, a significant player, has been reshaping the market, opening up new realms of possibilities. From fintech innovations streamlining transactions to artificial intelligence predicting market trends, technology is empowering investors and boosting market activity. Then we have economic recovery. After the tumultuous times we've seen, the green shoots of recovery are sprouting. Industries are bouncing back, employment rates are climbing, and consumer confidence is on the rise. This rebound is a potent driver for the market's upward movement, instilling confidence in investors and potentially leading to an increase in market participation. Low interest rates also play a crucial role. These rates have made borrowing cheaper, encouraging businesses to invest and grow. This surge in business activities often translates into improved company performance, reflected in their stock prices. Now, let's connect these dots. The combined force of technological advancements, economic recovery, and low interest rates creates a fertile ground for a stock market rally. Technology is making investing more accessible and efficient, the economy is showing signs of recovery, and low interest rates are fueling business growth. While the future is never guaranteed, these factors suggest a promising outlook for the stock market. Each of these elements in their own way is shaping a landscape where a market rally seems not just possible, but likely. As we step into the tail end of 2023 and look ahead to 2024, we're seeing a confluence of factors that paint a bright picture for the stock market. While the future is never guaranteed, these factors suggest a promising outlook for the stock market. Stay tuned, stay informed, and most importantly, stay optimistic.